We start with economics A level. That's paper 3. Types of businesses. Here we're going to talk about business behaviors. To know more about business behaviors, you need to understand the kind of business we have. So that takes us to type of businesses. Are you with me? Are you with me, please? Are you with me?
Yes.
Okay, so go. Types of businesses. So for businesses, we have the private sector organizations or the private sector businesses and the public sector organization or public sector businesses. So we're going to start with the private sector businesses. Why do we call them private sector businesses? We call them private sector organizations or businesses because they are controlled by the private sector. So they are controlled by individuals, companies, or shareholders. So here I wrote private sector organizations. These are organizations that are owned by individuals or companies and not the state. And when we talk about the state, we're talking about government. They are owned, controlled by individuals, companies, but not the government. That's why we call them private sector organizations. Do you get that? Okay. So the amount of profit to be made is determined by the objective of the organization themselves. So for private sector organizations, they have different objectives. And most of the time, they might not want to maximize profit. But whatever it is, whatever profit, whatever the amount of profit they want to make, it will be based on their objectives. Every business has different objectives. Some businesses want to maximize profit. Some businesses want to expand, they want to grow. Some businesses, they want to increase their market share. Some businesses, they have different kind of they want social responsibility. So it depends on the kind of objective a business has that will determine the level or the extent to which it's going to make profit. That is the point I'm making here. Do you get it, please?
Yes.
Great. So private sector organizations may be large or small. So we have large private sector organizations and we have smaller private sector organizations. Why do we call them large private sector organizations? These are companies. So yeah, with large companies, they are owned by shareholders and decision making is rests on the shoulder of directors and managers. So we call them large companies because they are owned by shareholders. And when we talk about shareholders, these are individuals who has a stake in the organization. That's why we call them shareholders. So, but for the control, for decision making within those organizations or large companies, it is by the directors or the managers. I think the point is clear. Then for small companies, we're talking about the private, the partnership or probably the sole trader. So these are examples of small businesses or small companies. So we're going to start with examples of small companies. We have the sole trader. Are you there?
Yes.
So why do we call them sole traders? We call them sole traders because we call it a sole trader or sole proprietorship because it is owned and controlled by an individual. So a sole trade business is a business that is owned and controlled by an individual. Do you get that? So a sole trader business is easy to set up as it requires little capital. That means the amount of money you have to set it up with is less and few, if any, legal requirements. So sometimes the paperwork, there might not even be any paperwork. You might wake up today and set up a small store in front of your house. Nobody's going to ask you a question about it. So that's why there's no legal requirement. So it's easy to set up. With little amount of money, you can set it up. That's why they say it is easy to set up. Any question about that? So that takes us to the features of a sole trader. Are you there?
Yes.
Okay. So these are the following features I wrote. One, easy to set up. It's a business that you don't need a lot of paperwork. You don't need large amount of money to start up with. Full control by the owner. So a sole trader does not necessarily need to employ workers. So he or she can take charge of the business. Owner keeps all the profit. All the profit made, because a sole trader, all the profit made is solely for the owner of the business. Unlimited liability. So the problem about a sole trader here is that for a sole trader, you cannot separate the owner from the business. So that's why it is unlimited liability. So the debt of the business can be transferred to the wealth of the owners. So if the business fail to pay certain debts, it might be paid through the assets of the owners. I think the point is clear. So that's why we call it a sole trader. Any question about sole trader?
No.
Good. Another small business we have is a partnership. Are you there? For a partnership, why do we call it a partnership? We call it a partnership because it's a form of business that is owned by 2 or more people. So mostly it's 2 to 20 people for partnership. Are you with me? So what are the features of a partnership? We have capital is contributed among partners. So that means a share of capital among partners, unlike a sole trader, which capital solely comes from. 2, share of responsibility. The responsibility lies on the shoulder of all partners. So that means there's share of responsibility because most of the time, one of the advantage of a partnership business is that they have different experts, which allows them to explore. Unlike a sole trader, you only have to rely on your own expertise, and that might not take you far. But for partners, they might have different people with different speciality, and that takes them far in the business. Do you get the point here?
Yes, sir.
Share of profit. That's the problem there. As a sole trader, all the profit is you own all your profit. But in partnership, you have to share profit with some of the partners. I think the point is clear. And still unlimited liability, the same as partnership. So whatever happens to the business affects the owners of the business. Any question about partnership?
No.
Great. You have that. Then that takes us to limited companies. Are you there?
Yes.
Okay. For limited companies, we're talking about companies that are registered through the registrar of companies. So they have legal formalities. So here I wrote, are you there, please?
Yes.
So these are companies that have gone through legal formalities to be registered. As soon as they are registered, they have limited liability as the owners and the business become separated. We call them limited companies because they have a legal, there's what we call business entity. They are different. The owners of the business are separated, are a legal entity from the business. So whatever happens to the business does not affect the personal wealth of the owners. That is what limited liability is. Unlike a sole trader and partnership that have what? Unlimited liability, which means whatever happens to the business can be transferred to the owners of the business. But for this, there's a legal identity, which means the owners are separated from the business. So the only yeah, as a shareholder, the amount of shares you bought are the only things you could lose. Whatever happens to the business cannot be transferred to your personal wealth. So what simply means is that if you are a sole trader, if your business is owing me and your business is unable to pay, I could take your car. But for a limited company, that is not possible. The only thing the owners of the business can lose if the business is unable to pay back its debts, it's the amount of money invested. Is it clear? Okay. Is it clear now, please?
Yes.
Great. So this means shareholders will only lose the amount of capital invested as share capital, and their personal possessions are protected. So we call them shareholders because they have their wealth being protected. Whatever happens to the business does not affect them. That's why they are shareholders, and that's why they are limited companies. Are you with me?
They can't make actions,
Actions.
like decisions.
Shareholders. We have the board of directors. We have ordinary shareholders, we have preference shareholders. Those that own the company that might be able to make decisions are part of the ordinary shareholders. And note, there's the board of the BOD, the board of directors. These are people that make decisions. They are part of the shareholders.
Okay, so for example, I buy 10 shares from Google. I can't make actions, right?
No, you're a preference shareholder.
You're a minor.
Yeah, yes. They have the ordinary shareholders, the owners of the business themselves. So the shares available to people like you are preference shares. So you're not going to be part of because at the end of each year, they have what we call the AGM, annual general meeting. So you're not going to be part of that. So those are the people that own the business themselves. So that's why whenever they have to share, whenever dividends have to come, they pay your dividends before them. So preference shareholders get their dividends ahead of ordinary shareholders. Do you understand? So you are their priority. They are in the business because of you.
Okay.
Do you understand? But decision making lies on the shoulder of the board of directors. So the board of directors will employ or nominate the managing director who takes charge of the operations of the organization. So the managing director will simply use maybe 3 years or 4 years. Then they will change him or her again. Is it clear now?
Yes.
So for dividends, when we talk about dividends, we're talking about the share of profit paid to shareholders. That is dividend. I think it's clear.
Yes.
Any question about dividends? Yeah. Okay. So for limited companies, we have the private limited company and the public limited company. Are you with me?
Yes.
So why do we call it private or okay, I start with the public limited company. The public limited company is the PLCs. So these companies can trade their shares in the stock exchange. So here I wrote, Public limited company, it is a company which can have its shares traded freely on the stock exchange in its own country or even on foreign stock exchanges. We call them public limited company because they can trade their shares in the stock exchange. I want to talk about the stock exchange. The stock exchange is a market where shares are being bought and sold. So as a public limited company like Apple, they are public limited companies. They can sell their shares in the stock exchange.
What do they mean when they say a company has went public? A company goes public.
That means it becomes a public limited company. So that means there is an initial IPO, initial public offering. We call it IPO. So as soon as a company becomes, as soon as a company becomes, as soon as a company becomes, as soon as a public goes, as soon as a company goes public, the first thing it does is the IPO, initial public offering. That means now you can trade your shares in the stock exchange. I think it's clear.
Yes.
Any questions about that?
No.
Good. So then we have the private limited company. Why do we call them private limited company? We call them private limited company because they can only sell their shares among friends and family. Their shares are not transferable, and they cannot be traded in the stock exchange. But they have almost the same features as a public limited company. Like there's limited liability, they have shareholders, there's a lot of paperwork that has to be done, like the public limited company. But the only difference is that for private limited companies, they cannot transfer shares. Each member cannot transfer shares, except if all members agree on that terms. And their shares cannot be traded in the stock exchange. I think it's clear.
Yes.
Any question about private limited, public limited, and
No.
dividends?
No.
And what the stock exchange is? You understand now, right?
Yes.
Great. So that takes us to cooperatives. Are you there?
Yes.
For cooperatives, these are businesses owned by their members, and each member has one vote on major decisions and issues. It is democratic in nature. We call them cooperative societies or cooperatives because they are owned by members. So that means the members, they come together, they set up that business. So each member has the right to vote on one major decision or one major issue. So most of the time, the cooperatives are democratically structured because each member has rights to be part of decision making. Do you understand cooperatives here?
Yes.
So for the profits are shared equally by members. Profits are shared equally by members because they mostly contribute the same amount of money starting up the business. So their main objective is to render services rather than to earn profit. Their main objective is not to make profit. Rather, they want to render services to their members. Is it clear?
Yes.
So we have three types of cooperative society or cooperatives. Three main types. One, we have the consumer cooperative. Why do we call them consumer cooperatives? We call them consumer cooperatives because they are owned by consumers who buy goods or services from their cooperative. So the cooperative, they form the cooperative because they used to buy from that business. Now they're setting up that business to buy from that business. We call them consumer cooperatives. It could be goods, it could be services. Clear? Then we have producer cooperatives. These are a group of producers or crafts people that come together to showcase or to process and promote their markets or products. So for producer cooperatives, I wrote, these are owned by producers of commodities or crafts who work together to process and market their products. So their main objective is to sell their products. So they come together to set up that market where they can showcase their products. That's producer cooperatives. Do you get that?
Yes.
And the last one are the workers cooperative, which are mostly white collar jobs. So when we talk about white collar jobs, like the bankers, teachers, doctors, they can also form cooperative society. So for workers cooperative, I wrote, these are owned and democratically controlled by employees who become a member of the cooperative. So they are owned by white collar jobs like teachers, doctors, lawyers. They form up the cooperative.
collar.
White collar job, yeah. I think it's clear. So that takes us to state-owned enterprises, public sector. That's SOEs. Are you there?
Yeah.
Why do we call them state-owned organizations?
Because they are owned by the state.
They are owned by the government. Yes, you're right. So state-owned enterprises, state-owned enterprises, these are large organizations that are created by a country's government to carry out commercial activities. Yeah, it is owned by government, but they also try to make profit because they do commercials like Emirates, like Etihad, Airlines. These are state-owned organizations.
Aramco.
Yeah, they make profits too, yes or no? But they are mostly owned by the state. So this may be owned fully or partly by the state. However, the states have significant control over the business, like Egypt Air. It's state-owned. So these are state-owned enterprises. So
Mostly airlines are state-owned.
mostly, well, let's say mostly anyway. But yeah, because the state controls the aviation industry mostly. So they want to know who comes in, who goes out. And without having stake or significant control over the airlines, then they can't have the airport because the airport is owned by the country. So that's why most of the airlines are owned by state, are controlled by state. I think the point is clear there. So SOEs profit are paid to the government. Examples are Emirates and Etihad. We talked about them already. So the profit they make is paid to the government. And they also add up to employment within in the country. So we go to for-profit and not-for-profit organizations. Are you there?
Mhm.
For-profit organizations I wrote. These are businesses primarily established to generate profit. They exist to make profit. We call them for-profit organizations. It's not written here, I'm just saying for. So we call them for-profit making organizations because their main objective, the reason why they are in existence is because they have to generate profit. I think the point is clear.
Mhm.
Then we have not-for-profit making.
Well, what about there are some companies they call NGOs.
Non-government organizations.
What are they?
They are not for profit making. They are charities because they are part of not for profit making organizations. Are you with me?
Yes.
So for not for profit making organizations, these are organizations that don't distribute profit to their members, owners, or directors. They use the profit or surplus they generate to support their aims. That means the profit they generate, they reinvest it into the purpose of their setting up. Do you understand? Any question about that?
No.
So that takes us to joint ventures. And when we talk about joint ventures, we're simply talking about two different entities coming together to form a new entity. Get the point here? Two different parties coming together to set up a new entity or a new project or a new product, a new business or project. That is what we call a joint venture. So yeah, I go joint ventures. A joint venture is a business entity created by two or more parties. They combine to seek the development of a single enterprise or project for profit, sharing the risk associated with its development. So we call them joint ventures because they are two different people, two different businesses are trying to come together so that they can share the cost of setting up a new business. They can share the profit of setting up a new business. They can share ideas to start up a new project. That's why we call them joint ventures. But mostly you have joint ventures when it comes to global markets.
Like what, for example?
Or I could think about setting up, I'm a Nigerian and I'm thinking about setting up a business, maybe an automobile business in Libya, but I don't have the knowledge of the Libyan market. So I will seek a business, a Libyan business, a Libyan entity that has the knowledge of the market. Then we'll come up together to form the business. That is what a joint venture is. So mostly we have joint venture businesses in the global markets, mostly for businesses that are trying to penetrate into the international market. They can't do it all alone because they don't have the knowledge, the local knowledge of the market, and also government of countries may not even allow them because most of the time government of countries will only allow a foreign business to set up in their country if they are trying to come up with a joint venture. So we get to know further anyway. So here I go. They are mostly set up between a global business that wants to expand into a new market and a local business that has knowledge of that market. So a global business that is trying to enter or penetrate into an international market, which it doesn't have knowledge. So it's an international business aiming at going into a new market abroad, but the local knowledge is not there. So you need a business that has a local knowledge that will allow you to settle in, to acclimatize. That is why there's joint venture. Do you get the point here?
Mhm.
So government of most countries will only allow foreign companies to set up in their country through joint ventures. This is designed to prevent exploitation. So like I said earlier, government of different countries, they won't allow you to set up without you coming up with a joint venture because they don't want you to exploit them. They don't want you to exploit their resources. They don't want you to exploit their citizens. They want you to transfer knowledge to them too, because one day you would definitely want to leave their country. So when you leave, everything lives with you. No. So they want to have stake. They want to have, they want to know what you do. So here I go. This is designed to prevent the exploitation of the country's resources and its people as to ensure there is transfer of knowledge. This in turn will improve the distribution of income and wealth in the country. So we are always talking about income distribution. When new firms come into a country or set up in a country, they employ workers from that country, yes or no? That increases income within that country. But it's still limited. Unlike when a new business comes in and collaborate with a local business to form a joint venture. That increases income and wealth of locals within the economy. And that increases the gap that reduces the gap between the rich and the poor. And there's transfer of knowledge too. So that is what joint venture is all about. So we call it a joint venture because it simply talks about two different parties or the two different entities coming together to form an entity that would come up with a project to make profit, to share ideas together. Is it clear?
Yes.
Any question about that?
No.
So that ends types of businesses. So you have activity one and hold on, please.